Goldman Sachs is out with a note today saying that while a significant increase in mortgage rates has historically weighed substantially on housing, the extreme supply-demand imbalance in today's market will likely dampen the hit on housing activity. Joining us now, Hatzius, Goldman Sachs chief economist. So Jan, what do you expect as far as the housing market outlook over the next year?
We are expecting basically a sideways move in residential investment because, as you said, as you summarize, the supply-demand imbalance is so extreme that we think there is only going to be a relatively modest hit to activity in the housing market. We did, however, downgrade our expectations for home price growth. This year should still be pretty strong, still have cumulatively 10%, partly because there's just so much momentum there, but then have a slowdown to sort of low single digits mid next year.
So is this going to be a challenge for the Fed because of the supply issues? I mean, housing is one of the primary mechanisms they weaken demand in the overall economy by raising interest rates.
Yeah, I mean, I think it is a challenge in the sense that you're going to get less of an impact through that channel. I do think there are some other factors that will probably bring growth down pretty significantly. I mean, the fiscal drag in particular, you need to take into account in addition to whatever monetary drag you see. But yes, housing taken by itself, I think is going to be less responsive than normal.
So what do you expect broadly then for the consumer, Jan, as we go through the remainder of the year? If housing demand holds up a little bit better this time, what does that say overall?
Well, I think consumer spending, again, slow growth. I think we will still see positive numbers, but trend or somewhere around trend in sort of the high ones, with obviously some ups and downs. We've been seeing a rebound in services, basically because of the rebound from Omicron. That's going to fade. We're seeing, some increases in infections again. I don't think there's going to be a large impact on activity, but generally, I think it's going to be a pretty sluggish environment.
You don't expect a recession this year, and I think have been increasing the odds that it happens next year. Are we still in the 30% or so range?
Yeah, I mean, our probability, and this is a judgmental probability, is 35% cumulatively of a recession starting over the next couple of years, which is higher than sort of the unconditional, just average frequency of recessions. But I think there is still, a narrow path to a soft landing. It's going to be hard to do because history says once the labor market is overheated, it gets harder for the Fed to pull off a soft landing. But as the economy slows, I think that would improve the probability. I mean, slower growth now would be good, I think, for the prospects that we don't have a recession.
So ultimately, when it comes to the Fed and the market's big, which way does the Fed have the bigger potential to surprise? On the hawkish side or on the dovish side, given the market is now positioning for so many interest rate increases and shrinking the balance sheet?
I mean, I do think there are upside and downside risks. I think the next couple of meetings, very likely we're going to get 50 basis point hikes. Beyond that, we do have a slowdown in the pace of hikes later in the year. I think that's basically because at that point, I think inflation is going to be somewhat lower. We're going to get a benefit in the goods sector, at least in terms of year-on-year changes. Growth, I think, is going to be slower, but it's certainly possible that they go in 50 basis point steps for longer. So, but you have to balance that against the risk of a sharper slowdown, and there is a meaningful risk that you do see a recession, even though that's not our baseline case.
Hatzius, thank you for your latest thoughts and for joining us here in the Market Zone of Goldman Sachs.